What does it mean for the mining space more broadly then, the gold mining space? Evie, does it fuel acquisitions, given the pricing, given the opportunities to expand footprints for some of these companies? Is that where this goes in the months and quarters ahead?
Yeah, Thomas, a good question. I mean, I think we've seen quite a few trends recently in that regard. So, the companies have been kind of dusting down the projects that have been on hold for many years. With lower prices, sub-economic returns have meant that many of the projects have been shelved. These are now being reviewed. But what we're seeing, most consistently across the board now is the companies looking to reward their investors. It's been a long time in the wilderness for many gold equity shareholders. They haven't had the dividend growth that we've seen in many other sectors, and the companies have been saddled with large amounts of debt and relatively low margins. That debt is now kind of mostly paid off, and the cash is coming through. It's being returned in dividends, but we're also seeing this rather surprising trend of share buybacks across the space. Now, I can understand the maths and methodology and thinking here, but it's always an alarm sign to us when a sector looks to redeploy its cash gains back into share prices. And we've got to remember that many gold share prices are up 100% year to date. Doesn't mean there isn't value in the shares, but is it really so wise to be buying back shares right now after such big gains, or maybe to have some cash on the balance sheet, or even just to pay it back to shareholders in higher dividend yields? I think that's what most people would prefer.
Evie, good morning. When you think about the underlying commodity, we think about gold and the strong run-up in prices that we've seen. How much do you attribute that to the drama that's been unfolding in alternative havens such as bond markets? Is that a link that's very present, and therefore is gold vulnerable if we start to see any change there?
Good morning, Anna. I think what we've seen driving gold over the last many years now has been a kind of gradual recognition across an increasing investor base that paper currencies are losing their purchasing power in a significant way. And when you extend that through into the bond markets, people are saying, well, do I really need to buy into government bonds at these relatively low yields, given the high rate of loss of purchasing power? And I think that's now starting to come through. When you add to that the expansion of government balance sheets and the ever greater need to finance activities by governments, as we're seeing in the UK here, with large amounts of spending not covered by tax revenues, there are only a few levers that they can pull. And I think that that is a realization across an investor base that the fundamental physical assets are going to preserve purchasing power better through time. And people have been turning to gold. I mean, it's been with us for thousands of years. It was forgotten about towards the end of the 1990s and early 2000s. But now when you look across many multi-asset portfolios, there is a tactical allocation to gold. And that's done many investors incredibly well over the last few years. And it's pleasing to us to see this coming through. We're also seeing it in central banks. Central banks are looking to build gold reserves out of their kind of asset bases, moving away from the dollar. And that's been a significant trend over the last few years. So I think as long as these trends continue, then we're going to have these tailwinds for the gold price, and that will flow through into the equities.